Many companies now offer shares as part of an employee's compensation package as a means to retain them for the longer term, and this can often be quite lucrative for the employee.
Many big tech companies have decided to set up shop in Dublin, likely as a result of the beautiful weather, the low cost of living, the affordable housing,
and the extremely favourable corporate tax breaks.
There are many different schemes and confusing tax implications when both purchasing or receiving company shares.
And when accepting a job offer, it's an important life and career decision to understand how you can take advantage of these schemes as well as what the risks are.
In this video, we're going to run through the main employee share schemes as well as the tax implications of these with a specific focus on Ireland.
If there's a particular scheme or section that you're interested in, please feel free to use the timestamps in the description below.
Okay, let's get it.
So, what is an employee share scheme? It is basically a way for employees to gain ownership of shares in the company that they work for, either through compensation or through purchasing.
And there are benefits to both the employer and the employee, and we're going to run through those now. Let's first look at the benefits to the employer. Firstly, employee retention. Generally, an employee will need to stay with the company for a period of time in order to get the shares that they're promised. The longer they stay, the more shares they're probably going to get. Shares offered to employees as part of these share schemes are vested or exercised, i.e. cashed in, at a certain point in the future. There's also the tax benefit to offering these schemes. For example, in Ireland, employers can avoid paying the 11% employer's PRSI if they pay their employees with equity as opposed to cash. Flexibility. Employers can be flexible in terms of what employees they offer it to, and of course be selective in their approach. Share schemes can also be a great motivator for employees, as if they have equity in the company, they're more tied and responsible for the company's success.
But what about the benefits to the employee? Well, the main one is the monetary value that you can get from the shares. If the company is performing well, the value of your stocks could go up quite significantly. Conversely, the value of your shares could go down quite a bit. That's the main risk when it comes to employee shares, but that's the nature of the game. Employees can also get free or discounted shares relative to the market rate. As with the employer, there can also be tax benefits for the employee. For example, in Ireland, with certain schemes, you can reduce your income tax bill if certain conditions are met. But more on that in a second. And also similar to the employer side of things, it can actually be a good motivator for you as an employee to have shares in the company that you work for.
There are many different types of share schemes, but they can broadly be split into two categories: restricted stock units, otherwise known as RSUs, and stock options. Within Ireland, you will also hear of approved share schemes and unapproved share schemes, and we'll go into more detail on those later.
But for now, let's start with RSUs. So, what are RSUs? Put simply, RSUs are shares that companies give to employees when certain conditions are met, usually a time period. You can usually receive a number of shares within the company or the cash equivalent of those shares. These conditions don't always have to be time-based. They can also be related to your individual performance, the company performance, or a whole host of other things. However, employees won't receive the shares until the shares vest, and this is basically the period that they need to wait in order to get the shares. This vesting period is usually spaced out over a number of years, and the initial vest usually takes place after a certain minimum amount of time has been reached, for example, 1 year, and then subsequent vests usually take place in more frequent occurrences, so for example, 3 months. Oftentimes, employers will use RSUs as a way to incentivize employees to stay longer as they receive the shares every few months. So let's take an example. Let's say you get a new job with a company like Google. As part of your compensation package, you're awarded 80 shares. At the time of the offer, the 80 shares are valued at $250 each, totaling $20,000. These shares are awarded over a 4-year period, and you only start to receive them after 1 complete year of employment. So you will receive the first 25%, i.e. 20 shares, of this after 1 year, and then 6.25%, i.e. 5 shares, every 3 months until the end of the 4 years. So, how are RSUs taxed in Ireland? Well, there are usually 3 potential taxable events. Firstly, given that they are considered to be part of your income from an employment point of view, you'll be charged income tax, USC and PRSI on your RSUs, and your employer will deduct this directly from your payslip at the vesting date. Generally speaking, some of the shares will be sold to cover this tax liability, which is known as the sell-to-cover mechanism, and this means you don't need to pay the tax liability directly out of pocket. Secondly, if the shares pay out dividends, you'll be liable to income tax, USC and PRSI on this income, and you'll be required to declare it on your annual tax return. either a Form 11 or Form 12. We have videos on both of these forms which you can check out later. Thirdly, you may be liable to capital gains tax on any gain that you make when you dispose, gift or sell the shares. At the time of recording, this is charged at a rate of 33%. If we take the example one step further to understand the tax implications, let's say that after 1 year, your shares at Google vest. Also, congrats on your 1-year anniversary. Google has been performing well ever since you joined, and the stock price has quadrupled to $1,000. So, for your first vest, the 20 shares you are awarded are valued at $20,000, as opposed to the $5,000 at the time of grant. Google will deduct the income tax, USC and PRSI at source on the market price, i.e. $1,000, so you receive the 9.6 shares, or $9,600. You continue to hold these shares for another year, and then you decide to sell these shares. You will be liable to capital gains tax on any gains that you make on these shares. Again, Google is really benefiting from your work, and the share price has tripled to $3,000. The shares you hold are now valued at $28,800. You'll be liable on the gain from the vest date, i.e. the $9,600, and this is your cost basis for calculating capital gains tax. Your total gain will be $19,200, which let's say is 17,000 euros in this example. You can take away your annual exemption of 1,270 euro, and this gives you a chargeable gain of 15,730 euro. The rate of capital gains tax is 33%, so your total tax due is 5,191 euro. To summarise, you have to pay income tax when your shares vest, i.e. when you get them, and if you subsequently decide to sell them, you have to pay capital gains tax on the gain. We have videos both explaining capital gains tax, as well as how you pay and file capital gains tax in Ireland, and you can check them out here.
The second broad form of employee share schemes are stock or share options.
A share or stock options is basically the right an employer grants you to acquire shares in the company, either at no cost or a predetermined price.
This predetermined price is also known as the option price, but it is worth noting that when we're talking about stock options here, they're not technically the exact same as what you might see on Wall Street bets.
Under a share option scheme, your employee will determine the number of shares you can acquire, the option price, or $0 if shares are given for free, and the exercise period, which are the dates from which and by which you may exercise your option.
There are a number of share option schemes available to people working in Ireland. We'll be running through a few of them, but do note that not all of them are going to be relevant, so again, a reminder that you can use the timestamps below to skip to a section that you are interested in. In Ireland, there are both approved schemes and unapproved schemes.
The main difference here is that for approved schemes, companies are required to get approval from Revenue in order to implement them.
This is usually to ensure that the employee is eligible for the tax benefits that the scheme provides.
I.e., they don't have to pay income tax on the shares in the scheme.
On the other hand, although an unapproved scheme might sound like it carries negative connotations, many of the global companies based in Ireland do come under the unapproved scheme.
So, let's look at some of these unapproved schemes first. In Ireland, it's important to note that if you are part of an unapproved share option scheme, you are responsible for the taxes on these shares, namely income tax, USC and PRSI. This means that the taxes are not done by your employer and that you are self-assessed. The two main unapproved share option programs in Ireland are the ESPP and KEEP. An ESPP, or an Employee Share Purchase Plan, is a scheme that companies use to allow employees to purchase shares, usually at a discounted price. This scheme is particularly popular with US companies who have employees in Ireland. ESPPs are pretty broadly applicable around the globe, and this means that these US companies don't have to tailor specific share schemes to the countries that they operate in. As I just mentioned, an ESPP allows employees to purchase shares in the company that they work for during a defined period of time, for example, per quarter. The discount allowed can vary by company, but usually it's around 15% of the market price. But what day is the market price taken on? Again, this can vary by company. Some companies could offer the first day of the quarter, some companies could offer the last day of the quarter, or in an ideal situation, some companies offer the lowest price day of the quarter. The downside of the ESPP is that you're responsible for paying and filing your taxes. In Ireland, you can be taxed for several different events for an ESPP. Firstly, the money you put into the scheme, i.e. the wages you are purchasing the shares with, will be taxed based on income, USC and PRSI. This is no different to how you will be taxed if you were paid the wages in cash, but just wanted to call it out. Secondly, you'll get taxed on the discount you get within the ESPP. This discount is considered as income given to you by your employer, and you will thus be charged income tax, USC and PRSI. It is extremely important to note that paying tax for this discount is your responsibility. This includes both the RTSO1 form and the Form 11. The RTSO1 form, or the relevant tax on share option, is a form that must be filed along with payment no later than 30 days after the date on which the share option is exercised. Subsequently, the following tax year, you You will also need to declare this share option as part of your income tax return on the Form 11. Fortunately, the RTS01 is a pretty simple one-page form, and we'll be doing a run-through of the RTS01 form in a later video. We'll link the video here and in the description once it's live. Thirdly, you may have to pay tax on any dividends that you receive from these shares. Again, this will be income tax, USC and PRSI, and you have to declare it on your Form 11 as you are considered a chargeable individual. Finally, if you sell the shares at a later date at a gain, you'll have to pay CGT on the gain. Revenue are constantly updating their systems and processes, so make sure to check in on the description to see if anything has changed since we recorded this video.
Another unapproved share scheme is KEEP. The KEEP scheme can be a little bit confusing, as although you do not need approval from revenue as a company to implement this, you may still get tax benefits from it. The aim of the scheme is in the name. It's an employee retention program which is implemented to keep employees. KEEP is only for small and medium-sized enterprises. The reason for this is that it allows these small and medium-sized enterprises to compete with larger companies when it comes to recruiting and retaining employees. The main benefit to exercising a share option under the KEEP scheme is that the gain is not subject to income tax, USC or PRSI. But if you subsequently decide to sell those shares, you will of course be liable to pay capital gains tax on the gain. Do note that not all companies qualify for the KEEP scheme, as certain conditions do need to be met, and we leave a link to those conditions in the description below. There are other examples of unapproved share schemes such as forfeitable shares, growth shares and convertible securities, but we will not be talking about those today.
Now let's look at approved schemes. For approved schemes, a company basically needs to get approval from revenue in order to offer these schemes to employees.
And the main benefit to you is that you can get tax-free shares up to the value of €12,700 annually. Off the bat, the first one, a little confusing because of the name, is the Approved Profit Sharing Scheme. The Approved Profit Sharing Scheme, or APPS, is a scheme within the approved category. Anyway, moving along. APPS allows employers to give their employees up to €12,700 of shares tax-free in a given tax year. Do note that this saving comes in the form of income tax, as you are still liable for USC and PRSI on the value of these shares, and you are also due to pay this when you are granted, i.e. promised, the shares. This amount will be deducted directly from your payslip by your employer, so you don't really need to worry about it. However, technically you'll be somewhat out of pocket during this retention period, as you're kind of being taxed on income that you haven't actually received yet, but just keep that in mind. Just for your own reference, these are the current USC and PRSI rates in Ireland at the time of recording. To be part of this scheme, certain conditions need to be met. 1. Your employer must hold the shares for a period of time called the retention period, and this is 2 years from the date on which they were promised to you. 2. You don't sell your shares for at least 3 years. For those first 2 years, you can sell those shares even if you wanted to. After 2 years have passed, you still can sell those shares if you choose to, but you will have to pay income tax on the value. If you wait the full 3 years, then you can sell them without any income tax due. After that 3-year period, if you do decide to sell those shares, you are still liable for CGT, but of course your option to sell them is yours to make. A quick example to illustrate. Let's say your employer offers you 1,000 shares at a value of €3 per share for a total value of €3,000. USC and PRSI is paid on this €3,000 amount at the time you're appropriated the shares, i.e. promised them. At time of recording, at the highest rates of 4% PRSI and 8% USC, this would equate to €360 upfront. This tax will be deducted from your paycheck, so you don't need to take any action, but again, keep in mind that you'll be a little poorer that month. Let's say you waited the 2 years, i.e. the retention period, and then decided to sell those shares as soon as that 2-year period passed. The moment you notify your employer that you wish to sell the shares, you will need to pay income tax at the standard marginal income tax rate of 20%, and this will be taken directly from your paycheck. If you're in the higher income tax bracket, i.e. 40%, you need to pay the balance once a sale actually goes through. 20% will have already been paid, so you'll need to make a self-assessment for the second 20%, and you'll do this through Revenue's website. The taxable amount is calculated based on the lower amount of either 1, the total market value at the time you were promised the shares, plus any gains in value since then, or the current market value when you instruct your employer to sell them, and it's the lower of the two. Remember though, you will not have to pay USC and PRSI on this amount, as you'll already have paid it. So in summary, given this knowledge, it's probably worth waiting the full 3-year period to avoid the income tax entirely. In this situation, no income tax is due, you've already paid your USC and PRSI, so the shares are yours. If down the line you then decided to sell those shares, the only tax you would be liable for is CGT.
The next approved scheme is a SAYE scheme. This is otherwise known as the Approved Savings Related Share Options Scheme. Half the struggle with all these schemes is simply just remembering the names. For this one, just think of PAYE only for savings. Participation in the scheme is voluntary, but it may be a good way for you to compound your income and savings. Under this scheme, your employer may grant you share options, or in other words, the option to buy shares in the company. Your employer sets the option price before you start saving in the scheme. The main benefit is that the price can be set to a discount of up to 25% of the market price on the date that the option is granted. Under this scheme, if you decide to exercise the option, you'll be exempt from any income tax on the gain when you do so. The main condition is that you need to wait at least 3 years before you exercise these options. In the SAYE scheme, there are two main elements: the savings part and the share option part. For the savings part, you must save between €12 and €500 per month. Usually employers offer a 3, 5 or 7 year savings contract. They will deduct the savings from your net salary and they will place these savings on deposit with a bank or savings institution. Any interest you make during the savings period is exempt from income tax or dirt, but realistically, this is going to be pretty measly. The second part is the share options part. Once you complete the savings period, you can decide whether you want to exercise your option to buy the shares. The amount you have saved must be enough to cover the option price as set by your employer. If you decide not to exercise your option, the savings will be returned to you from the bank or savings institution, and these will be tax-free. So let's take an example. Let's say your employer granted you share options under SAYE. The market value of the shares at the grant date is €6.25 per share. Your employer sets the option price at €5 per share, which is a 20% discount. You save €100 a month for 5 years. At the end of the 5-year period, you have saved €6,600, which is €6,000 savings plus €600 interest. We're definitely being very generous with this interest rate. Also to note, you do not need to pay income tax or dirt on this interest. So you decide to buy 1,320 shares at €5 each, which is €6,600, i.e. the amount of money that you saved. The market value of these 1,320 shares though is €15 per share, and this equates to a total of €19,800. The exercise gain you will therefore have is €13,200. When it comes to taxes, you will not have to pay income tax, so that's zero. Let's say you're in the higher brackets for USD, and this will be 8%, and that equates to €1,056. And again, you're in the higher bracket of PRSI, and this equates to €528 on your exercise gain, giving you a total tax bill of €1,584. If, of course, the share price is below the option price at the end of the savings period, there may be less incentive there to actually buy the shares. In this case, you can of course just withdraw the savings as cash rather than buy the shares.
One other approved share scheme to be aware of is the Employee Share Ownership Trust, or ESOT. We won't be discussing that in this video, but if you do want to learn more, we'll leave a link in the description and you can find it there.
Employee share schemes can definitely be a lucrative offer for anyone considering joining a new company.
That being said, as we outlined in this video, the names of all these share schemes, etc., can be very confusing. So if anything is unclear, do let us know in the comments below. We'll be happy to help you out.
And if you enjoyed the video, be sure to drop us a like.
And otherwise, see you in the next one.